Anyone who's considered buying a mobile home park asks, what kind of financing can you get? Like any other investment, leverage can make or break a deal. In this episode, I'm going over the different financing options for a mobile home park so you don't need to buy it all cash and you can maximize your return on investment. By the time we're done, you'll know exactly where you need to go to line up the debt for your next mobile home park. Hey, Mario Dattilo here. Welcome back to the show where we talk everything mobile home parks. Before we get going, hit that subscribe button to follow the channel, and it's completely free. And make sure to hit that bell so you get all the new notifications for episodes. Financing's changed a lot, even since I started buying parks back in 2015. Lenders are learning a lot more about the industry, and there seems to really be a strong appetite for them. So here's the top 5 sources of debt for your mobile home park purchase or refi. Number 1, banks. This is where everybody thinks to go for a mortgage, and they're important, but they don't always have the most attractive terms. So what are banks actually good for? Banks are great for properties that aren't stabilized and are underperforming. They're perfect for when you're buying distressed or value-add properties with like a lot of deferred maintenance or large capital improvements to do. I found that banks either love or hate mobile home parks, so get that out of the way up front and don't try and educate them. Banks will usually finance a portion of the improvement costs, and that's going to help you leverage more of your upfront costs. 70 to 75% loan to cost is where I try to land on most of my deals. You can usually get interest only for like the first year or two since you're turning the property around. You'll want to keep the cash flow up when you've got a lot of changes happening there. You can expect 3 to 7 year fixed rates, and the loan's either going to balloon or the rate's going to start to adjust after that. Generally speaking, banks are focused on the borrower first and the collateral second. They're almost always going to require you to sign personally on the loan since to them, you're their best source of repayment if things go south. Bank interest rates are usually pretty good, but they're not always going to be the lowest. Be okay with it since they're really lending the money at the earliest and riskiest time of the deal. The slightly higher rate is usually worth it. Expect amortization between like 15 and 25 years, and this is somewhat negotiable. Guys, prepay penalties and 1% origination fee are pretty normal too. Negotiate the prepay penalties so they work with your business plan. If you plan to refi in 3 years, then have most or all of the prepay penalty end or be reduced by then. Banks are great, and without them, you'll have a hard time buying value-add deals. So build some strong relationships with a few good banks, and they'll become a big asset to your business. Number 2, CONDUIT, also known as commercial mortgage-backed securities and CMBS for short. These are probably the most complex lender of the bunch, and they're also the most flexible lender for stabilized properties. It's pretty interesting how CMBS works. A team of people that have a big credit line, they draw money from it and then lend it to others to finance their properties. In return, they get a mortgage securing that money. Then, when they've lent enough money, they line up a large institutional investor to buy the entity that owns the mortgages. After buying it, they securitize the loans by selling off shares of that entity to a bunch of small investors. So people who want to own mortgages can buy a small percentage of the pool. Complex, right? Where do CMBS loans really come into play? Well, they're good for larger loans on stabilized properties. So if you've completed your turnaround and you're ready to refinance, you can do it with a CMBS lender, and you can recoup some or all of your initial equity. Expect 75% LTV, a 30-year amortization, and a 10-year fixed rate that balloons. The interest rates are going to be pretty good. One unique thing to know is that you're going to be quoted a rate on your initial term sheet, but you don't lock in your rate until the day of closing, which can be a bit nerve-wracking. Your closing costs and legal fees on these are going to be on the higher side, so you need to take that into consideration. These have big prepay penalties called defeasance and yield maintenance, so this is not the kind of loan you want if you plan to refi or maybe even sell before the 10 years is up. If you thought the explanation on how these loans are originated is complicated, Google how the prepay penalties are calculated. The loans are assumable, so you can sell the property to a buyer and they can get qualified to take over the loan. Best of all, these lenders care about the collateral first and the borrower second. Because of this, the loan is generally speaking non-recourse, so you don't have to personally sign for the debt. This becomes really valuable as you scale your portfolio. Non-recourse debt allows you to minimize how much personally you owe, so you can keep borrowing on additional properties as you go. You'll need to use a commercial mortgage broker to line up a CMBS loan, so stay tuned, and later I'll tell you how you can get introduced to my personal commercial broker. Number 3, life companies. The life insurance companies take insurance premiums, and instead of setting them in savings accounts, they reinvest a large portion into all kinds of assets, one of them being real estate. Life cos tend to be the most conservative, but they do have their place. These lenders want to make sure that they get their money back so they can pay out life insurance claims as needed. Typical terms look like this: 15 to 30 year amortization. You've got a somewhat negotiable balloon period between 10 and 15 years. There's also the opportunity where you could be fully amortized for really good properties. Loan to values are a bit lower, around like 65 to 70%, and the rates are usually really good since they're lending on the best quality and the lowest risk properties. Prepayment penalties are going to vary, but they're usually at least a few years worth. You need to think about the fact that closing costs are not as high as CMBS or other agency loans. Recourse and non-recourse options are negotiable here, especially with lower LTVs. Consider a life company for your nicer, stabilized parks that you can refi and be at a relatively low LTV that you plan to hold for a while. This type of loan will require a commercial lender to help you with as well, so stay tuned. Number 4, agency lenders, Freddie and Fannie. These are the biggest and typically the most attractive lenders you can get if your property qualifies. Similar to your home mortgage, these quasi-government private companies put specific parameters in place of the type of loans that they want to buy. Approved lenders can actually underwrite and close the loan with one of these agencies, agreeing to buy the loan shortly after closing. So what does a loan with an agency lender actually look like? 30-year amortization is the norm with these loans, ranging from 10-year balloons to being fully amortized. Rates can sometimes be the best out there. Loan to value can often be 75 to 80%. They also want the cleanest and the nicest parks and are known to be a bit finicky about the condition. They're strict on the percentage of park-owned homes. They prefer curbing and paved parking pads, and they really like the newer home inventory, and they're attracted to double wide, so they're a bit touchy. Agency loans are also non-recourse and perfect for refinancing your turnaround larger, prettier parks to recoup the initial equity invested. They have prepaid penalties, but also allow a buyer to assume the loan. Something unique about these loans is you can have supplemental loans to pull out more cash later. This can make the loan far more attractive for a buyer who's planning on assuming the loan, so they don't have to come up with a larger than normal down payment, but they still get to benefit from your attractive terms. You'll want to use a commercial lender that does a lot of these loans and has a good relationship with the agencies. Number 5, bridge loans. These loans are used to get you into a deal quickly and get it turned around. They're offered by a number of institutional lenders, and it can be useful, but it's also a little risky due to the short-term nature and higher costs. Rates can be 1 to 2% higher than other traditional financing options, and the term can be from 2 to 5 years. Prepay penalties and upfront fees can be on the higher side too. Since they're bridging you from purchase to being stabilized, they're usually interest-only loans, which really helps cash flow. These are a good option for deals that wouldn't qualify for bank loans. I'd recommend working with a commercial lender who can guide you through the negotiations on a bridge loan and really point out the potential risks that you're taking. Bonus: private debt and hard money. This is the wild west of the debt world, and more funds are offering this type of product. The catch with this one is they're all different and negotiable. You should expect higher interest rates because private might be several percentage points above a bank. Hard money, they'll likely be 10% or more with multiple points up front for origination. They're expensive loans and really should only be used when you're sure the deal can afford it. You can also use them when you have a loan in the works with a bank, but you need to close faster than the bank can do it. You then turn around and refi when the bank's ready. Private and hard money debt should be used for really attractive deals that lenders can't lend on, and it still makes sense even with all the extra interest and fees required. Usually they're property focused, and you should try to avoid signing personally on the loan. They usually fall under what's called asset-based lending. If you want a referral to a great mobile home park lender that I personally use, my email is mariodattilox@gmail.com. I've dropped it in the comments below too, so just send me an email asking for an intro. They're going to be able to help you successfully navigate all the loan types we talked about here. Here's what I ask in return. If this video was helpful, please click like, drop a comment, and if you really liked it, hit the subscribe button. I recently did a video on inflation, and one of the most profitable strategies to hedge against inflation utilizes debt, so click on this video here to learn about it.